Today we have a special guest, Mr. Harsha Upadhyaya, the Chief Investment Officer and the President at Kotak Mahindra Mutual Fund.
I think in this business, I don't think you can avoid mistakes. So if you put 100% in equity, there will be periods where you will get disappointed. Let's say you reach the second station much faster than you were supposed to reach. Would you just get down at the second station, or you still sit in the train and go to Delhi? The destination is more important.
Admirer of your Kotak Flexi Cap Fund. There's a skin in the game where I have my own portfolio in Kotak Flexi Cap. What we tell in Tamil, Totrani Thuru Manarkeni Mandarku Katrani Thuru Marivu. It's all about Akbar had Birbal, Chanakya had Chandragupta, Shivaji Maharaj had Tanaji. Likewise, for mutual fund industry, it's all fund managers. Today we have a special guest, Mr. Harsha Upadhyaya, the Chief Investment Officer, Equity and the President at Kotak Mahindra Mutual Fund. Under Harsha's leadership, Kotak Mahindra Mutual Fund is the fastest growing mutual fund in the industry. They manage more than 6 lakh crores of asset management in the industry. Welcome, Harsha. Thank you for your time in spite of your busy schedule, and we really appreciate your time in speaking to us.
Thank you so much. It's a pleasure having a conversation.
So, in this discussion, we will not hold you long, maybe 15-20 minutes of your timeless knowledge and the wisdom that you have been doing it in the last 2 decades. We would like to, have a conversation with you. My conversation with you will be in the 4 parts. Basically, your investment journey in the last 2-3 decades, and your advice to the retail investors per se, and the current market conditions, and maybe a quick rapid fire questions to complete with. So from a mechanical engineer to IIM Lucknow and to the finance background, if you could throw a light of how your investment journey would be in the last 2 decades, what was your thought process then and now, and how you started, that would be of help for us actually to start with.
Sure. So even when I was doing my engineering, I was interested in finance. But of course, my basic degree is of engineering, right? Post that, I joined IIM Lucknow and did my management degree in finance from IIM Lucknow. And during that period, I also did a summer internship in a company doing equity research. So that's how the journey started in terms of my interest in stock market, which got reinforced by the summer internship that I did in equity research. And I was also fortunate to get a placement after my MBA from the campus into an equity research profile, right? Those days, of course, market was not so deep. There was very few organizations which were focusing on equity research, investment management, etc. I was fortunate to get into equity research just after completing my MBA. And first 10 years was in equity research, covering different sectors of the economy. And later on, after about 10 years or so, I moved into the role of a portfolio manager, fund manager. And the last 20 years have been in the role of fund manager and CIO in Kotak, etc. So it's been a long journey, but I think I've been fortunate to do something which I wanted to do. Even if I was not an equity research person or a investment manager, probably I would still have continued to do that as a hobby. May not be to the same extent, but as a hobby. But I am fortunate that I am in a role which allows me to do that while I am doing a job.
What we tell in Tamil, Totrani Thuru Manarkeni Mandarku Katrani Thuru Marivu. It's all about, learning throughout your lifetime. It's very interesting to know. The reason why I asked, I just wanted to know, is there any defining moment in taking this as the role that you are doing in? And was there any particular market event or a mistake in early part of your career that significantly influenced how you manage the money today?
No, I think in this business, I don't think you can avoid mistakes. This is not a business or a sport or a profession where it's going to be 10 out of 10 or a bullseye. That can only happen in gymnastics or in shooting or in archery, all of that, right? In this business, you have to assume that there will be many periods where you will go wrong for your own mistakes, or it could be because of how the external environment changes at different points of time. And that's why we diversify our portfolios to an extent that some of these mistakes also don't cost you so much, right? So that's the way that you need to manage. So I'm not saying that you can avoid mistakes or you have not done mistakes. You will do it, and you will, even after managing money for 20 years, 30 years, you will keep doing some mistakes.
So investment is not arithmetic, you say?
No, I mean, investment is about managing your greed and fear, and also making sure that you have done a certain amount of analysis before taking any bet that may or may not go as per your expectations. If it doesn't go as per your expectations, you need to change either the portfolio or your thinking, or you have to reanalyze that position, right? But there is no way to say that I have bought 10 stocks and all 10 stocks will do extremely well. If it happens, it's luck. I don't think one can say that it will keep happening all the time. So that's how this profession is. And the more money that you make on the right kind of stocks that you pick versus how much you lose in a bad bet that you take is what defines how much wealth you can create over a what period of time. And also, as you can reduce some of the mistakes, at least if you are able to not make the same mistakes again and again, that itself should add to your overall performance over a period of time. And that's what we try to do. I mean, we try to remember some of the mistakes that would have happened in the past. We try to avoid those, but it doesn't mean that it will be zero mistakes.
Very interesting perspective. How has your investment style evolved over the period of last 2 decades, maybe 2.5 decades?
It has remained the same, I would say. We keep looking at businesses which are competitive, which have a large canvas in terms of the growth opportunities, I would say. We don't want to buy today and think of whether the company has enough scope to grow or not over the next 3 months. If we are buying something, we should at least be willing to hold it in the portfolio for a long period of time, as long as that business continues to grow.
I'm a great admirer of your Kotak Flexi Cap Fund. You know, there's a skin in the game where I have my own portfolio in Kotak Flexi Cap, where I have been holding these investments for a very long period of time. All our investors hold a very significant position in Kotak Flexi Cap. So you are not a contrarian per se. You buy stocks at a reasonable price.
Correct.
And you always look at the growth.
Our portfolios will be tilted towards growth, and there is a reason to do that. I mean, we believe that India, being an emerging market or a developing market, will always offer more opportunities on the growth side. But of course, every time there is growth, the idea is to see whether it is already discounted in terms of valuations, or is there something left on the table. That's where at reasonable valuations. So we will look at growth companies, but not that every growth company which is probably available at very expensive valuations. We will be looking for companies which are growing and which are available at reasonable valuations. So that's the philosophy that we have.
So Harsha, now the distribution angle. You know, we manage customers' emotions, we manage the customer's portfolio. The retail investors per se, you know, before they enter into mutual funds, they do F&O, they do day trading. There are more crypto investors than the mutual fund investors. And every retail investors today, if you notice it, post-COVID, you know, everybody wants quick money. The people don't see test matches today, people see only T20s. The people don't want long cooking, people want only 2-minute noodles. So everybody wants quick money, and there are a lot of investors have come post-COVID, and last 18 months we have seen a lot of, you know, issues, or probably investors have not seen any great returns in the last 18 months because the patience level is very low. What do you want to tell to the retail investors, how actually they can see, how they can take this journey, especially the investors who have come post-COVID?
See, clearly, if you are seeking for thrill, if you are seeking for short-term upside, short-term money making, I don't think equities would offer that. If it offers, it will be, as I said, it could be because of some fortunate event that has happened or something that favors you at that point of time. But on a sustainable basis, it's very, very difficult to continue doing that. So if you're coming in equities, please come with a longer time horizon. It's like running a business, right? No business gives you overnight profits. Every business will have ups and downs. But if somebody does the business in a right way over a long period of time, that person actually becomes quite a good wealthy person. So what we are doing in equity mutual funds is also same thing. Instead of betting on one single business, which you otherwise would have done it for yourself, you are probably betting on 50, 60 different businesses that are run by very able professionals, managements, and hope to make sure that out of those 50, 60 bets, some of them will give you more wealth than what you would lose in some of those not so great portfolio picks that you may have. But essentially, you should have a longer time horizon. And also the other thing, as you mentioned, some of the investors are disappointed because of the sideways market or the volatility that has been there in the market. If you are not going to withstand volatility, I think fixed deposits, fixed income funds would be the right asset classes. If you are in equity, there will be volatility, there will be ups and downs. But if you keep those investments for a long period of time, the volatility may not show up, right? For example, if you look at the chart of, let's say, Sensex or Nifty in 2008, now when you look at that chart from, let's say, 2000 to 2026, you may not see a big fall in the year 2008. But if you had looked at it at that point of time, it would have looked like a 50% fall, right? So the longer you stay in the market, these ups and downs will come, but as long as the underlying businesses are making money, you as an investor will also make money. So the idea is to remain invested for a long time. And of course, how do you beat this volatility? You have to invest as you grow, right? You will be earning income on a regular basis. Similarly, you have to invest also on a regular basis. So SIPs, STPs will be the right way to build that portfolio. It also makes sure that you buy it at different levels of valuations of market, and hence over a long period of time you will be able to see the benefits of managing that volatility and also the compounding that happens over a long period of time by being in equities.
So the reason why I asked this, the earlier question, is that every 10 years the Nifty has become Sensex, if you notice it in the last 2 decades or 3 decades. But the investment returns are totally different from the investor returns, which we are seeing in our own industry.
Yes.
The reason in the distribution angle that we are actually facing is that it is something like what I tell in the video is that, you steam rice and dal in a cooker, and you are not allowing it to cook. You just take the whistle once in a minute without allowing it to cook, and you will have to give time, which is not happening. What I tell, the PDF, patience and discipline and the focus, is actually missing as far as the retail investors are concerned. What do you want to tell to the retail investors and the young investors who aspire to build wealth in the mutual fund? Say, what is when we talk long term, the longer it is better. Maybe what is the longest, in the sense 10 years or 15 years, or what is the time frame that one should minimum look into while they are first time starting into the equity investments per se, Harsha?
I think you gave a very good example of pressure cooker. I mean, if I have to give a similar analogy, for example, if you are traveling from Chennai to Delhi on a train, there are many stations that come in between. Let's say you reach the second station much faster than you were supposed to reach. Would you just get down at the second station, or you still sit in the train and go to Delhi? The destination is more important than how much time it has taken to reach a particular destination, right? So that's where I think many investors go wrong. Either they get down from the train much earlier, or they expect the same speed to continue throughout the journey. That also may not happen. So ultimately, you have a certain time frame, you have a certain expectation in terms of returns. As long as that is met, you should not really worry about other issues. So I would say the longer the term, the better will be investor experience. But at least 3 years, I would say, is definitely required for equity. The longer the better, but at least 3 years.
So what I tell, because when we manage the emotions, we'll have to use all this metaphor to explain to the retail customers. Even dhire dhire mana dhire dhire sab kuch hai is what we tell.
Yeah.
You know, even if you pour 100 liters of water,
Correct.
the fruit or the seed will only come during the season.
Correct.
So that patience is what
very
it is
important.
actually making. So when we started, or when I started career, I remember we used to sell 25 lakhs, 50 lakhs mutual funds. They're not 250 rupees or 500 rupees. Today, the
Anybody can
accessibility,
participate, yes.
Anybody can participate. Even a smaller people can participate through the mutual fund route. That was not there 20 years before. The manner in which the industry has evolved over a period of time has been fantastic. If a 25-year-old wants to build wealth systematically, it's an added question to what I asked. What principles they should follow, in your view?
I think we have already discussed about benefits of long-term investing. I would say 3 mantras. One, the focus should be long-term. It's not about what happens over the next 3 months, next 1 year, but you are building it for your own retired life, your own family, and for the next generation in some cases. So that should be the approach. Second, it has to have a prudent asset allocation. What do you mean by asset allocation? Just because a certain asset class has done very well, it doesn't mean that it will always give same kind of past performance. Just don't look at past performance and go into a particular asset by 100%. Right? If equities have done well in 2020 to 24 period, it doesn't mean that it will do well in 2025. So if you put 100% in equity, there will be periods where you will get disappointed. So you have to manage your risk and your expectations through asset allocation. Equities, fixed deposits, savings deposits. There has to be insurance to protect yourself and your family. There has to be other asset classes like probably commodities, all of that. I'm sure
Gold,
you do a better job in terms of understanding each investor's needs and then providing that avenue to make that asset allocation. And the third important thing is, in your life, let's say you gave an example of 25-year-old. Maybe he has just started to work, he or she, right? But at 26, he'll get an increment. 27, probably he'll get another increment. 28, maybe he'll change the job, he'll go somewhere, he'll get more money, right? So every year you are trying to get more money for that year, right? But there will be a point of time where what you have saved, what you have invested is a significant component. Most people forget about what money that they have created over a period of time, but they still aspire to get a higher increment, better job in that particular year. But you are forgetting about what you have created over last 10 years, 15 years, which can really take you to next level in terms of the wealth creation. So not only your income of the year is important, but managing the assets or the wealth that you have over a period of time is also very important. And the second thing is, as person starts to get higher income, either through salary, either through business, similarly you should also invest more, right? If you are investing, let's say 5,000 rupees in the first year, and if your salary increases by 20%, you should ideally increase your investments also by 20%. You should start investing 6,000 rupees next year. That is how you will be able to build a bigger corpus for a longer time.
So you exactly nailed the point. What you are telling is the portfolio sizing.
Correct.
You know, I used to tell in all my videos, you know, having an investments of 1 lakh and having 20% returns, how much you would have made? 20,000 rupees. Suppose you have 1 crore of portfolio, even
Correct.
if you make say 9-10% returns, it is 10 lakhs.
Correct.
So we will have to focus on the portfolio sizing.
Exactly.
In addition to what you told, any book recommendation for the young investors who wants to learn about investing?
No, I think there are multiple books on investing.
Any one from your end?
Each one will give you a different flavor. I don't think picking and choosing one book would be right. But anything that supports a long-term investing, which makes a person understand asset allocation, importance of asset allocation, should be a good read.
In terms of market, Harsha, what do you see the biggest risk to the Indian markets over the next 3 to 5 years? We are talking about the India story. Though the India story is intact, India is in sweet spot. For Google, they want India. For Facebook, they want India. India is actually in a sweet spot where the demographic profile is at an advantage to us. But there are a lot of threats, if you notice it. AI threats that we are talking about. Job is a big threat to every individual between 25 to 45. The threats like the rupee problem that we have seen. There are so many things that it is there in the mind of the retail investors, who believe that gold and silver and other products can actually, give them a very good wealth creation. Actually, what an investor should see, because there is a lot of noise around the market where we talk about financial planning, asset allocation, diversification and rebalancing the portfolio, but too much of a noise is there in the market for the retail investors to focus on one thing and build the portfolio. So what are the biggest threats that you see in building this portfolio in next 10 years and what one should avoid?
See, I think two things you have to do, but it is easier said than done. You have to manage your emotions of greed and fear. There will always be greed. You mentioned about gold and silver. Probably most investors are wanting to invest in gold and silver because of greed. Because it has done so well as against any other asset class, they want to put all their money there, which is again a wrong thing, right? Last year was a great year for gold and silver, but there is no guarantee that next 3 years or next 5 years will also be as great, right? People wanted to invest in equity in 24 because 2020 to 24 was great, but 25 was not so great. So every time if you chase past returns, that may or may not happen, right? So that's where managing emotions of greed and fear is very, very important. And if you can do that without focusing on past returns, I think that's the best way to manage a long-term portfolio.
Most of our investors have got a decent allocation in the multi-asset portfolio of Kotak. Just done exceptionally well in the last cycle. In fact, one of the top performed scheme in the category. Tell us something about this multi-asset, where it should be part of the customer's portfolio, or you still feel that one can have 10-20% tactical allocation as gold and silver in retail investors' portfolio, because like you told, the recency bias is too much. People only chase the asset class which has done well in the past. Now there is a FOMO is there, fear of missing out is there. There are a lot of influencers there in the market who are advocating only gold and silver will outperform any other asset class. Before dollar was there, gold was there. So there are so many stories attached to this narrative actually. So we have been advocating the multi-asset fund to all the customers. But should the customer look into this multi-asset portfolio, or some 10-15% standalone gold and silver will help them in the long-term investments?
Both are okay, just a vehicle that you are choosing. If you are choosing a multi-asset product, essentially you are doing that asset allocation through a single product. There is some equity, there is some fixed income, gold, silver, all of that in single fund. And most of these funds also come with equity taxation, which means if taxation is inferior for fixed income or other asset classes, you still get the benefit of equity taxation because the fund has more than 65% in equity. That's one way to do it. The other way to do it is, as you explained, you can continue to own multiple funds, some equity funds, some fixed income funds, some gold ETF, some silver ETF. That's another way to do it. All these will be in separate funds instead of one single fund. But essentially, it's about taking position in different asset classes based on your risk tolerance and return expectations and the investment horizon. So there is no one size fits all for everybody. If you are coming in multi-asset products, there is one size, you should be okay with that particular size, right? Then if you want any alteration in terms of higher equity, higher gold and silver, you have to additionally go and buy those funds. Otherwise, you can decide your asset allocation and then pick up different funds in different categories.
So if Harsha has got 100 rupees today, maybe 10-15 years I should say, where he will allocate?
I would not probably allocate too much to commodities and fixed income at this point of time. The portfolio tilt will still be equities. But yes, there will be some part of commodities, some part of fixed income.
Through multi-asset?
Multi-asset or differently. It's fine. I mean.
So under your leadership, Harsha, I must tell you, the Kotak mutual fund has grown. In fact, it's a 5th largest mutual fund company in the industry. I was talking to Madam Chitra the other day. Where I sell, Kotak pamphlets way back in 2002, standing in the Spencer Plaza, distributing 25 lakhs, 50 lakhs sort of a product. Now it is 250 rupees. The journey in the last 10 years that the industry has seen and the manner in which that Kotak AMC has grown has been phenomenal. What is that has done well for Kotak AMC per se? Harsha as an individual has done wonders at Kotak Mutual Fund Company. Probably give us some insights or what process or what measures that you actually do it at Kotak, which would be of help for us, Harsha.
No, as you rightly mentioned, I think the process is really important and the team behind it. While we as fund managers, maybe we are more visible to investing public, but there is a large research team which is behind us, which is supporting us in terms of the research output. And I'm very proud to say that we have only mostly added people to our research team rather than losing our team members to competition or anything. And over a period of time, all of us know how each other behaves, how each other thinks about investments, all of that. So it becomes easy to work in a environment where each one of us know what other person is looking for, what other person's strengths are, what other person's weaknesses are. So as a team, I think that has helped us a lot. And of course, we have been at the right time in terms of the tailwind that we have seen for the industry, right? I mean, as you would know it, as most of the investors who have participated would know it, industry has also seen a lot of inflows in the last decade or so. And if you have had a good team, good consistent performance, that tailwind would have also been more for those kind of fund houses, and that is exactly what has happened with us. So we've been thankful for that as well.
We're very fortunate to be in the industry also. Ashad, some quick rapid fire questions to finish it off. Growth or value?
Growth.
Large cap or mid cap?
Right now, large cap.
Active or passive?
Always active.
India only or global diversification?
For most people, India only also helps. But definitely, just like commodities, international should also be part of the portfolio.
How much percentage would you?
Maybe 5%, 10%.
5%. One word for current markets?
Usual.
As usual.
As usual.
Most underrated sector at this point of time?
Unfortunately, I don't see any underrated sector because you will see those kind of phenomenon when market has not done well for many years. There are some ignored pockets where valuations are very, very low, etc. We are already at a level where valuations are at long-term averages. So you will not find too many of those such sectors.
Wealth is created by what? Wealth is created by?
By patience and focusing on long term.
One habit every investor must build?
Saving.
Habit?
Asset allocation and again long term investing. I think if you keep doing those things, which is easier said than done, you will be able to reach your destination.
So saving habit and asset allocation.
Yes.
Biggest investing myth?
Past performance is going to get repeated.
Bull markets are born when?
bear markets die.
Very insightful, Harsha, actually. Timeless wisdom and your experiences will be very valuable to all our subscribers. And thank you so much for your time in spite of your busy schedule. Really appreciate it.
Thank you so much.
Thank you, Harsha.
Thank you.